Hi, this is Ken Crotty, and I just want to thank everybody for taking the time to attend our Learning at Lunch series. Today we're going to discuss the nuts and bolts of Florida LLC law and practices. Wanted to make sure everyone's aware that we have a lot of material here. We're not going to be able to go through it all in half an hour, but I'm going to hit on some highlights. And if you have any questions in the slides, feel free to email me or anyone here at the office, and we'll be glad to help you provide some more information or clarification on some of those items. Before we turn into the actual LLC webinar portion that we're going to be discussing, I did want to just go through a couple of slides showing some of the upcoming presentations that we have. So you can see here, Form 1023 line by line will be presented next Thursday by Michael Lehman. It's going to be a great discussion. The Form 1023 is the application that you file with the Internal Revenue Service to allow an organization to qualify as a charitable organization. In addition to that, over the 2 following weeks, we have Colleen Flynn, who is a local attorney who specializes in employment law, and we regularly consult with her. She's going to have one on hiring employees as well as a second one on terminating employees. And in addition to that, we have a schedule showing what we have coming up through the end of October as well. So we hope that you'll be able to attend some of these webinars and that you find them useful and helpful in your practice and provide you with some information that you otherwise might not have available to help you better represent your clients and make sure that you're maintaining and running your practice to the best of its ability. And again, we have some additional webinars scheduled all the way through January of 2020, which you can see there as well. So if you have any questions on those, please feel free to give us an email, and we'll be sure to address them as well. So turning to the LLCs, one thing that we wanted to highlight is that in Florida, if you have an LLC with multiple members, you're going to have charging order protection for that LLC, and it's as strong a protection as you have for any other entities. The statutes that we have under Florida law are very easy to understand relatively compared to other jurisdictions. And one other thing to point out too is that if you have an organization that you want to merge into an LLC, whether it's foreign or domestic, you'll be able to do that using some of the forms that you have on the Secretary of State website, which we think has been constructed very well. And it would allow you to convert the entity into a Florida LLC. All right, continuing with a couple of other highlights. One is that you are able to establish the LLC by filing the Articles of Organization. You can structure it so that it would be a voting or non-voting interest. You can have an irrevocable manager. You can structure it so it has a manager or a member-managed entity as well. All of this can be done online. In addition, you can dissolve the entity online, and you can also file your annual reports online. It's important to note that the annual reports for LLCs are due by May 1st of every year to avoid penalties. If you are looking to dissolve the entity, one other option that you have is just fail to file the annual report, and eventually the Secretary of State will administratively dissolve the entity. And the benefit of that is that you don't have to actually pay the fee to dissolve the entity, and your client doesn't have to pay the expense of having you prepare the forms to dissolve the entity. If you're doing other things with LLCs, such as mergers or conversions, or transferring inside or outside of Florida, unfortunately, those are going to require wet signatures. You're going to need to fax or paper file the documentation. Generally, the Secretary of State does a very good job of quickly turning these things around and or providing you with the effective date that you requested when you filed the documents. Okay, a couple of other things to highlight. This is just something that we noticed is that save yourself a couple of keystrokes. You can link in the favorite page for Sunbiz into what you use the most. I normally find that I'm looking for the names of the entities, but it's just something to consider to help save you a couple of keystrokes, save you the time during the course of the day. One point to realize under Florida is that there is generally a lack of confidentiality in the sense that the officers and managers of the LLC are going to be listed on the annual report and also on the Secretary of State website. The biggest thing that I take away from this for my practice is that if I have someone who wants to be confidential and also to be the manager of the LLC, even if we change the name of the LLC to ABC LLC, LLC, if they're listed as the manager, their name's going to come up on a Sunbid search. So the easiest way to get around this is to use a second entity as the managing entity. With single people, we frequently would form it in Colorado. With married couples, we might form it in Delaware or in Wyoming. When you search on the Secretary of State website in Florida, it would just show that entity as the manager. It would no longer show the client's name. And if someone went to the Secretary of State website for Colorado or Wyoming or Delaware, and they plugged in the name of that LLC, they would not get any information regarding the management of that LLC. Instead, they would just show that it was in good standing. So that's the easiest way to remove the client's name from being searchable on the Secretary of State website for Florida. In addition, you can use your office and address for the documentation for the entity. So it removes the home address of the individual or the business address of the individual from being on the Secretary of State website as well. So that's something to consider, again, for confidentiality purposes. I've got a couple of slides here that I'm not going to go into, but we thought they would be a good resource, and it just kind of gives a brief overview regarding some of the benefits or filing requirements or detriments of whether you select to be treated as a regular corporation or professional association, as an LLC or limited liability partnership or a general partnership. Also, again, a brief review of the difference between the taxations of C Corps, S Corps, partnerships, and sole proprietorships. Now, it's something to consider is that people often get confused in the sense that they think if they form an LLC, they don't have the choice of selecting how that LLC will be taxed. You do have several options. If you're a single member LLC, it could be disregarded entirely. You could elect to have it treated as an S corporation or as a C Corp. If you have more than one member, you have the option of, the default being a partnership. You also have the option of making it an S Corp or a C Corp. One thing to consider, and I'd be happy to send you additional language if you would like, is that if you are going to have an LLC taxed as an S corporation, you want to make sure you have provisions in your operating agreement to prevent the entity from failing to qualify as an S corporation. The easiest way to do that would be to have a second class of stock. Now, voting is not considered to be a second class of stock, but if you had differential rights with respect to receiving profits from the entity, that would be a second class of stock. There also are some restrictions on who can be S corporation shareholders or members of the S corporation. So you want to have specific language in your documents to help prevent it from inadvertently no longer qualifying as an S corporation. I do not believe we have that in this material. If you would like to see the language that we typically use, send us an email and we'll be happy to send it to you. Also have a quick review of why you might pick a partnership versus an S corporation, especially with respect to real estate. Generally, the partnership is going to be a better model for real estate. So again, with an LLC, you have the option of picking which entity or how the entity is going to be taxed. And that's going to really be dependent on what the client wants, what the entity is invested in, and who the members and or shareholders are for the entity. One thing to note, and this is something that we run into here in Florida than I think you do in more than other areas, is that if you have a Canadian investor, they might expect that a Florida LLC would be disregarded if it was a wholly owned LLC or with a family entity. The problem is that under Canada law, the LLC is treated like a C corporation, and so therefore you would be exposing your client to double taxation. The easy way around this is that for whatever reason, if you form a limited partnership instead of an LLC or a limited liability partnership instead of an LLC, then you're going to have the pass-through treatment. So you're going to avoid the double taxation issue just by not forming an LLC. So even though this presentation talks about the benefits of an LLC, this is one of the hazards. This is a situation where you would want to form a limited liability, limited partnership. If you're doing that under Florida law, one of the reasons that we oftentimes do not do that as opposed to an LLC is that the filing fees and costs associated with it tend to be higher than the LLC from the state standpoint. All right, quick slide on rental house ownership strategies. So this is trying to make it confidential. If we place the house in the name of one spouse, you wouldn't know the second spouse had an interest. But if you rent it, you could have liability issues. If we have an LLC that's owned by the first spouse, again, the second spouse would not show on the Secretary of State, but it could be very difficult then to get insurance to cover it. And the way that we wrap around this for the benefit of our clients in most situations is that we would use a land trust with spouse one as trustee. This makes it easier to get insurance. The land trust would designate that the LLC is the beneficiary, and then the LLC could have a separate manager as shown on the right-hand side. And again, if you want complete confidentiality, you would go ahead and name the manager of the LLC as another entity so that the client's name is not on the Secretary of State website. If you want more information on this technique, which utilizes various LLCs, it's what we call the new F-parent reorganization. We'll be happy to send it to you. What this allows you to do is that if you have an entity such as a medical practice, which has equipment and furnishings, practice operations, real estate, and accounts receivable, you can utilize Section 368A1F, which is applicable to LLCs, and tease out the various portions of the entity into separate LLCs to help segregate and firewall any of the liability associated with the various portions of the practice. It's a great planning technique for the benefit of clients. It's tax-free when it's done, when the reorganization is done correctly, and it helps provide a great deal of creditor protection for clients that they otherwise would not have. Okay, the Florida LLC Act, we've had this now in effect for several years. One of the main things to be considered and make sure you're aware of is that one of the changes that was made by the Act was changing it so that you could have a member-managed LLC. So if you state that a LLC is managed by its members, it is not managed by a manager. Instead, it's managed by the members. The biggest reason that you may want to avoid this is that it provides the members then with more of a degree of control, a higher degree requiring the consent to take actions, and it would limit the ability of a member who was serving as manager to take actions. Now, when I say a member serving as manager, you can be a member, but if you are designated as the manager and the LLC is manager managed, then you are acting in your capacity as manager with respect to the LLC. You can have more control over that, as opposed to if it's a member managed LLC, even if you're designated as a member manager, it doesn't mean that you have as much control as you otherwise would. So it's something to review the statute and make sure that your operating agreements are providing the level of control that the clients want with respect to the operation of the entity. Operating agreements are customizable. The LLC Act does provide certain provisions which you cannot contract around. The rest of the provisions are default provisions. However, it's best practice to make sure that you have exactly what you want stated in the operating agreement rather than relying on the default provision, just to make sure that it functions properly for your clients. Management and control, we talked briefly about the management. Now this is turning to an estate tax standpoint, is that from an estate tax standpoint, if you want to take a discount with respect to the value of the entity for lack of control or lack of marketability, then you should be in the habit of forming the LLCs with voting control and non-voting interest. So the voting interest could be a 1% membership interest. The non-voting interest could be a 99% non-voting membership interest. If you transfer the non-voting membership interest to a trust for the benefit of, say, family members, etc., you should be able to take a discount for lack of control and lack of marketability because the non-voting interest does not have the control over the interest in the entity. Frequently, these are in the range of 35%. So it's a very useful technique for helping to reduce someone's wealth under the estate tax filing threshold and or to reduce their potential estate tax exposure if they're over the filing threshold. It's also a great way to take into using the discounts if you're trying to do inter-family sales, such as installment sales, which can be disregarded for income tax purposes, but would help to shift wealth to the trust and out of the grantor's estate, thereby reducing any potential exposure to tax that the family would otherwise have. When you're transferring the ownership interest, you do need to make sure you double check the rules that are stated in the operating agreement. Sometimes there are restrictions on the ability to transfer certain shares. Other times you need the consent of all the members. Sometimes it's just the unanimous consent of the managers. Sometimes you need the manager and a majority of the members. Again, it's something you actually need to read through the operating agreement for, and make sure you do that, especially if you're dealing with an entity that you did not create, because your base rule does not necessarily apply to the operating agreement for that entity. What we've done too is provided just what we have as a standard sample assignment. In this situation, it would require the consent of all of the members and the manager of the LLC. There's no strict legal reason it has to look this way. We just wanted to provide you with a sample showing how we typically would do it. Now, with LLCs, to provide better creditor protection, you do want to make sure that you're following the typical corporate formalities. One such thing would be having annual minutes prepared for your clients. And here's a list of some of the general items that we asked for. Typically, we would work with the CPA for the client to make sure that we get all the necessary information to help complete the minutes accordingly. And we just provided you with a sample minutes that we would have as well. And again, there's no legal reason it has to look like this. We just wanted to provide you with a sample of what we use in our forms for our clients. And the sample minutes continued. Choice of entity discussion, this is going to just, again, touch on, I'm going to gloss over this because it has the information that we discussed earlier regarding whether you want to be a partnership, a disregarded entity, or an S corporation, and what the various filings are. It's just presented in a different format and with a little bit more detail, especially with respect to disregarded entities. With respect to LLCs that are owning real estate, one thing that you do want to make sure that you're aware of is that, again, the difference between treating it as a partnership versus an S corporation. And I have material later in this outline. If you have an entity that owns real estate in Florida, the LLC can file a statement of authority with the Secretary of State. The statement of authority is valid for up to 5 years, and it lists specifically the individuals or entities who have the authority to transact with respect to that real property. If you get a certified copy of the statement of authority, that can then be recorded in the applicable county where the property is located, and that would put a prospective purchaser on notice with respect to who has the authority to deal with the property. So in today's day and age where we have so much fraud and other items like that, this is an easy way to help protect the interest of the LLC in the property so that someone does not mistakenly think that they're dealing with a manager or somebody else that has the authority to transact with respect to the property. Reporting requirements for partially owned grantor and grantor trusts. This is dealing with LLCs that are disregarded. I have more information on this as well if you want to. I could be happy to send it to you. But basically, you're going to be reporting either on Schedule C, Schedule E, or Schedule F all of the income picked up on the grantor's personal 1040. And the grantor trust would file an informational 1041 showing all zeros, but then the statement showing that the income is picked up on the grantor's personal return. So again, it's just making sure that you properly report for the IRS when you're dealing with a situation with a LLC that you're treating as disregarded, especially if that disregarded LLC is owned by the grantor and by a grantor trust. Now, a grantor trust is a trust that's treated as owned by the grantor for income tax purposes, but not for estate tax purposes. And so we would take the position that the LLC could be disregarded from the grantor because the grantor has a direct ownership interest in the LLC and also has an indirect ownership interest in the LLC through the ownership of the trust. So even though there are multiple members from a state law standpoint providing you with the charging order protection, it's only one owner from a federal standpoint and could still be treated as disregarded. Possible need for multiple LLCs. This is something you want to make sure you consider with your clients. If they have one LLC for marketable securities and they buy a rental property, do not place the rental property in the same LLC. Form a separate LLC for the rental property. That way, if someone gets hurt, slips and falls, and the insurance doesn't cover, the property in the rental property LLC may be exposed, but you're not going to expose the assets of the marketable security LLC. And by a similar token, if they have multiple rental properties, make sure the client's aware of the risk that if all of them are in one LLC, they could lose some or all of the properties, versus if they are rental properties in multiple LLCs, they should be segregated from one another and not be exposed to the potential liability associated with one parcel or one slip and fall. There are some carrying costs associated with this. There's no right or wrong answer, but you want to make sure that you've provided the information to the client so that they can make the decision correctly and document it for your file as well. All right. Scrolling through quickly. Proper management of operation of a family LLC. What we do want to do is make sure that the client uses the LLC in the proper manner to help keep the creditor protection. So don't use it as a checkbook. This should be used as a nest egg. Money should be put in and left there. You don't want to see the client paying their cable every month out of the check or out of the LLC. You do want to maintain separate books and records for the LLC, even if the LLC is disregarded and will just be picked up on the grantor's personal 1040. It's best to at least have a QuickBooks separate record showing it being treated as a separate entity, even if it is not a separate entity for state law purposes. All right. We don't want to have personal use items contributed to the LLC because then that could allow creditors to more easily pierce through the protection of that. Again, we do want to have annual minutes, like we talked about earlier. And then it's good to make sure that the client checks either with you or with the accountant or another advisor just to make sure that they're maintaining it correctly throughout the course of the year. Again, to help make sure that that LLC structure is respected and provides the client with the creditor protection that they're expecting. Or observing corporate formalities, as we discussed. One thing to make sure is pro rata distributions. This is something we frequently see, is that the client may have an LLC that they own 95% of and 5% is owned by a trust, and the client may take $100,000 out of that LLC. The problem is that the trust should have received a corresponding distribution. So in my example, if the client owned 95% and took $100,000, then the trust should have received about $5,200, which would be the pro rata portion of the distribution. So whenever a situation occurs where you do not have a pro rata distribution, we recommend having minutes being drafted to document that, and then also an adjustment agreement would take into place. Now, this is an adjustment agreement sample that we have to take into account a capital contribution. And in this situation, one of the two members contributed cash, which you can see and we have as 1623141 in the green. And as a result of that, the membership interest was increased from 95% to 97.462. Because the other member did not contribute assets, its membership interest was decreased from 5% to 2.538%. Again, so this would be signed to document that the ownership of the entity was changed to take into account the non-pro rata contribution. And we have spreadsheets that we draft on Excel, which are specific for the client, but similar to this, which would show you how to work the calculation. So if you want a sample of either of those, please feel free to email us and we'll be happy to send it to you. A couple things to think about in your operating agreement. There is a difference under Florida law between an executory contract and a non-executory contract. A executory contract is a contract where both sides still have obligations to perform. A non-executory contract is something that can be more easily set aside by a trustee in bankruptcy. So this is the case in Re Eman, E-H-M-A-N-N. And so what I would suggest you do is Google this, look at some operating agreements and some articles that have been written with respect to this to see what you can add to your operating agreement to make it more likely that it will be deemed to be an executory contract, thereby helping to provide with additional creditor protection. One of the things that we do is requiring future contributions. So over a 5-year period, the members are going to be required to make additional contributions, assuming that it is something that is required by the managers, et cetera. We do have some caps on that, but this does make it so that it is more likely to be deemed an executory contract. In addition, we have the fiduciary duties of the managers and the members specifically stated so that they have an obligation to the existing members and to future members. All right, now turning to another portion of the creditor protection is Article 8 versus Article 9, and how do you perfect a interest that the LLC has as far as a security interest in the LLC. So if you're lending money so that someone can purchase an interest in an LLC, which would be an inter-family sale, let's say, under the Uniform Commercial Code, if the LLC documentation is silent, then Article 9 controls. And under the Uniform Commercial Code, if Article 9 controls and there's a creditor situation, the only way to be perfected is by filing a UCC financing statement. Now, many people don't want to have that happen, and as explained in more detail on this, what you can do is opt into Article 8 in the operating agreement for the entity, and clearly state that on any membership certificates that you have as well. And by opting into Article 8, perfection is achieved by holding the membership certificate for the entity that's pledged. You don't need to file a UCC-1, and so it's not a member of public record, which is the biggest benefit for most clients. But in addition to that, there's less expense associated with the UCC-1. You also don't need to worry about having a tickler in place to make sure that you maintain the UCC-1 accordingly. So this is described in more detail over the next couple of slides. It's something that is very much a trap for the unwary. But it's something that you want to make sure that you're aware of and are structuring properly in your documents for your clients. So again, we have as a sample the second sentence of our Section 2.01. The membership interest of the members shall be governed by Article 8 of the Uniform Commercial Code. And then in addition to that, at 12.08, when we talk about our membership certificates, again, specifically states in the membership certificate that the interest is governed by Article 8 of the Uniform Commercial Code. Irrevocable managers is something that can be, is permissible under Florida law. So if you're dealing with a situation where an LLC is going to be owned by the client's children, you may want to provide that the client is the irrevocable manager. It's something that everyone would need to agree to at the time of formation, but it makes it much harder for the client's child to challenge the structure in the future, and would give the client some degree of control to help make sure that the child does not have unfettered access to the assets. So it's something to think about. Again, here's a sample clause that we have in our management provision. And then also you would want to make sure that you add that to the Articles of Organization as well. So here's some language that we would add to our typical Articles of Organization that are filed, to help make sure that it's clear that we have an irrevocable manager. Single versus multiple member LLCs, and this is one thing that is extremely important under Florida law, is that under Florida law, if you have a single member LLC, the charging order is not the sole and exclusive remedy for a creditor. If you have a multiple member LLC, then the charging order is the sole and exclusive remedy. So the easiest way to have multiple member LLC would be, again, for a client to form a trust for the benefit of the client's spouse and or the client's children, and transfer an ownership interest in the LLC to that trust. There's no bright line test on the percentage that needs to be transferred, but so long as it's a legitimate transfer and so long as it's maintained correctly, then you'll have a multiple member for state law purposes, even if you only have one member for federal purposes. Again, it's extremely important, especially if you're dealing with a single individual and they're looking for the creditor protection of an LLC. If they own 100% of that LLC, then charging order is not the sole and exclusive remedy. And this is the Olmstead case that became an issue for. So you want to make sure that you have multiple members for your LLCs. And one simple way to do that is to create a grantor trust that would be owning a small portion of it. Now, for anyone that's not familiar with what a charging order is, the charging order basically prevents a creditor from reaching in to access the assets of the LLC, and says that the creditor can only satisfy a judgment when distributions are made from the LLC by taking the distribution. So by limiting the charging order, or by limiting the creditor's remedies to a charging order, it makes it much more likely that they'll be willing to settle with respect to a claim. So very, very important that you have multiple members. And we've got some other detail on that as well. Now, if you do have a charging order, there is some question with respect to tax reporting issues, because if the interest has the charging order and it's supposed to go to the debtor and it's a pass-through entity, this is some information you may want to read, especially if you represent if you represent creditors, because they may be liable for the tax obligations associated with the entity, even if they're not receiving distributions. Again, the sole and exclusive remedy is a charging order for multi-member LLCs, so this is very important, but it's well worth reading through just to make sure. And then here's the Olmstead case. Plenty of articles have been written about it. It's something that's worth taking the time, reading through, making sure you're aware of it, making sure you understand some of the fixes as far as how to avoid some of the potential issues. One change under the new Florida Act is that members do have the power to disassociate. This is very specific based on the statutes, 605, 0602. For the most part, it deals with this section, so it's something that I would encourage you to read and make sure you're more familiar with so that you can limit it to the extent ability, or the extent you have the ability in your operating agreements. Tenants by the entirety's ownership, we always get concerned that we want to make sure it's clear that a husband and wife are able to, or two spouses are able to own the interest as tenants by the entireties. This is sample language that we have in all of our operating agreements to make sure that it's clear that an ownership interest owned by two spouses is tenants by the entireties, and that is especially true even if one spouse is a manager. It doesn't have an impact on the fact that the ownership interest should be treated as tenants by the entireties. And then finally, what I want to wrap up on, and this is self-explanatory, it's amazing how quick a half an hour goes, but I want to let you go because the rest of the day needs to be billable, is that we have 8 common planning errors. If you're going to just look over anything briefly, this would be, it's written by Alan, and I think it's a great little handbook on the 8 most common things that we see in LLC operating agreements and or the maintenance of LLCs that helps to prevent them from being as effective as a planning vehicle and creditor protection vehicle for our clients. So the first thing would be making sure that the asset or the interest actually qualifies as tenants by the entireties. Second, disqualifying the S election. The third is making improper distributions. And fourth is that you want to make sure you have the right forced sale provisions in there if you intend to do that, especially if you're dealing with LLCs that are used by non-family members. Number 5 is the idea of the client forming it themselves and maintaining it themselves without any help from you or from CPAs or any other professionals. All right. Number 6 is, again, assuming that LLCs are as well protected in the other states. It's something that's very state law specific, so you want to make sure, even though we've been talking about Florida LLCs, that you do have the same level of protection that you assume you have here in Florida in other states. Number 7, failure to properly respect the formalities. This would prevent or allow the creditor easier access if you're not observing the necessary formalities. And then number 8, realizing that personal activities may not be insulated by the use of an LLC. So again, all of these are covered in more detail in the presentation that we just went through, but if you're just looking at the snapshot, little handbook, 4 pages, this is the way to go as far as refreshing yourself on what you need to be aware of and what can possibly be issues for you and clients down the road. So with that, I just want to say thank you very much for the attendance, and I appreciate everybody paying attention. If you do have any questions, feel free to send us an email and we'll be happy to address them. Or if you'd like more information on the material that we have, again, feel free to send us an email and we'll be happy to send it to you. And then just here at the end, again, with just reminders that coming up next week, we have Michael Lehman. So if you are interested in forming charitable organizations, this is one of the leading experts in the field in the country, and he will be able to go through how to properly prepare the Form 1023 application. And over the next 2 weeks following that, one of the best attorneys certainly at least in this area, Pinellas and Hillsborough, with respect to employment law, Colleen Flynn, is going to be providing 2 great webinars as well on hiring and, unfortunately, terminating employees and making sure you do that properly. So again, I want to say thank you to everybody for their attendance and hope everyone has a great afternoon. Enjoy the rest of your week and have a great weekend.